So let's talk about something. There's this quiet crisis brewing in a market that, believe it or not, controls the cost of pretty much everything in your life. We're talking your mortgage, your car loan, even the price of food at the grocery store. It's all connected to a huge problem that's about to hit the US bond market.
And this, right here, is the multi-trillion-dollar question that's literally keeping economists and finance ministers up at night. See, the US is going to need to borrow record amounts of money. But here's the kicker. The usual lenders, the big, reliable buyers of its debt, they're starting to walk away. And look, the answer, or really the lack of an answer, has direct consequences for your wallet. This isn't just some abstract Wall Street thing. This is a Main Street crisis in the making, and it could very well redefine your entire financial future.
To really get what's at stake here, we've got to start with the basics. We need to look at what US government bonds, or Treasuries as they're called, actually are, because they are so much more than just an IOU from the government.
Think of it this way. They aren't just government debt. They're literally the plumbing, the bedrock that the entire global financial system is built on. Banks use them as their safest form of capital, they're the collateral for trillions of dollars in transactions every single day, and they anchor the value of the US dollar. So if this foundation cracks, everything built on top of it starts to wobble. And it all comes down to something we all learned in school, right? Simple supply and demand. That's what sets the price of money for everyone. When tons of people want to buy US bonds, the government can get away with paying very little interest. But when those buyers disappear, well, the government is forced to offer higher and higher interest rates to lure people in. And those higher rates, they don't just stay in Washington. They ripple out and hit everything from your credit card to business loans. And the scale of this whole thing, well, it's just mind-boggling. You've got to understand, the US debt system operates like this relentless refinancing machine. The government doesn't really pay off its old loans, it just takes out new, bigger loans to cover the old ones. So the government is just constantly rolling over old debt with new bonds. And get this, nearly $9 trillion has to be refinanced in just 3 years. Now here's the problem. That old debt was sold when interest rates were basically zero. The new debt, it's being sold at much, much higher rates. And that is what kicks off this really dangerous feedback loop, which you can see right here. So to attract buyers, the government offers higher yields. But those higher yields mean their borrowing costs go way up. We're talking billions more in interest payments. That, in turn, leads to bigger deficits, which forces the government to issue even more debt. All that new debt floods the market, which means, you guessed it, yields have to go up again to find buyers. And the whole spiral just feeds on itself.
So this brings us right to the heart of the matter, the absolute core of the crisis. Just as the US needs to borrow more money than ever before, its most reliable customers are vanishing. It's a classic case of a massive flood of supply crashing right into a sudden drought of demand. And this is where you can see the fundamental shift that's at the heart of this whole problem. For decades, the market was dominated by what you'd call price-insensitive buyers. Think central banks, both the Fed and foreign ones. They bought US debt for policy reasons, not really to make a profit. But now, the main buyers are price-sensitive. Hedge funds, regular households, they don't have to buy. They'll only lend to the US if the price is right, and that means demanding much higher interest rates. Okay, first up, let's talk about the Fed. For years, through something called quantitative easing, the Fed was the #1 buyer of US debt, just soaking up trillions. Now it's doing the complete opposite. With quantitative tightening, it's letting those bonds just roll off its books, which effectively makes it a seller. The biggest customer didn't just leave the building, they flipped the sign on the door to seller. But the really big one, the one that sent a truly seismic shock through the system, that came from geopolitics. When the West first froze Russia's assets and then later decided to actually seize the interest from them, it sent a shockwave through every central bank on the planet. It basically broke an 80-year-old gentleman's agreement that US Treasuries were a neutral asset, totally above politics. And that one question, it just lays the whole thing bare. Every central banker, from Beijing to Riyadh to Brasilia, looked at what happened to Russia and had the same exact thought. Wait a minute, our nation's reserves could be used as political leverage against us? The weaponization of finance completely shattered the trust that made US debt the world's go-to safe asset. And when you look at the numbers, it's not even a question. Foreign ownership has just cratered.
It's at its lowest point in over 20 years. And this isn't some temporary dip, okay? This is a strategic, systematic retreat from US debt by the very countries that used to be the most reliable buyers.
And then, as if that wasn't enough, you've got Japan, America's #1 foreign lender. For decades, Japanese investors ran this thing called the carry trade. They'd borrow money for practically free in Japan and use it to buy higher-yielding US bonds. But now, for the first time in a generation, Japan's own interest rates are going up. That trade just doesn't work anymore. And another massive pillar of demand for US debt is crumbling away. All right, so what happens when this historic tidal wave of new debt crashes into this sudden collapse in demand? This is where all those different threads we've been talking about pull together, pointing toward a huge breaking point in the very near future. Well, it leads to this really scary scenario that economists call fiscal dominance. And even folks like former Treasury Secretary Janet Yellen have been sounding the alarm on this one. It's basically the point of no return, where the Fed loses its independence and is forced to just print money to pay the government's bills, because the bond market simply won't.
Now look, the official government projections, they're already pretty grim, and that's assuming things stay relatively stable. But when you look at independent analysis, like this one from Bridgewater, which just assumes interest rates stay high, well, the picture gets a whole lot worse. The difference in assumptions leads to a vastly more dangerous outcome.
So you can see how this has been building, right? The events of the last few years have perfectly set the stage for 2026. Each step on this timeline has chipped away at demand right at the moment when the need for that demand is about to explode. This is what people are calling the refinancing wall. Which brings us to the final and maybe the most important point here. The end game we're talking about isn't just another recession. It's the potential for a fundamental reset of the entire global financial system. And the consequences of that go way beyond a simple market downturn. See, the real risk isn't just that prices go down, like in a normal correction. The risk is a sudden freeze, a liquidity collapse, where the whole market just stops. We actually got a scary preview of this during the UK bond crisis back in 2022. For a few days, there were just no buyers for UK government debt at any price until their central bank had to jump in. And if you want to know how the big players are reacting, you just have to follow the money. Or in this case, follow the gold. As central banks lose faith in paper assets held in other countries, they're making a historic shift. They're buying physical gold at the fastest pace since 1950, and, this is the important part, bringing it home to store in their own vaults. Why? Simple. You can't freeze or digitally seize a bar of gold. It's the ultimate trust me not asset. So this whole mess forces all of us to ask a really fundamental question. For our entire lives, for 80 years, the safe asset was US government debt. If that's not true anymore, then what is? The answer to that question is going to reshape not just the global economy, but the interest rate on your mortgage, the value of your savings, and the very nature of money for decades to come. The search for a new safe haven is officially on.